Eric, welcome back. Everyone, this started off, I thought I would do half an hour or a short period of time with Eric as teaching me a little bit about risk management in banks. And very quickly, I realized that this was going to turn into multiple episodes because I was learning so much and having so much fun. There was so much to cover. And so we're now in episode 3, and Eric is going to bring us back up to speed. And I'm not going to try not to get too much in your way, although I do love asking you questions. So back to you, Eric.
I think it's excellent with the questions, Guy. Thank you. So it's such a pleasure to be back. I can briefly sketch where we were last time. We talked about the components of interest rates, how they disaggregate into the term structure or risk-free rates and also the risk spreads. We talked about the Basel Committee scenarios and how they are used to shock the yield curve, that they have been recalibrated. And then the preview for this time was that we would dive into net interest income and EVE. And in terms of the overall overview where we stand now, so in the first episode, we talked about the regulatory framework, that there's no minimum capital requirement, but we have Pillar 2 and Pillar 3, the supervisory outlier test and the risks. And I've did a bit of homework, as I promised last time. So the BCBS, that was founded in 1974, the Basel Committee on Banking Supervision, and that's the committee that sets the Basel Accords, or the Basel 1, 2, and 3 frameworks. Now, Basel 1 framework came out in 1988. That set minimum capital requirements. And there's quite a lag between 1988 and the 1974 establishment of the BCBS. BCBS, they were established originally after the Herstatt failure. You certainly remember that. That's a German bank that failed due to FX market participations. And what had happened, it caused a lot of FX settlement risk. So counterparties to Herstatt Bank had already paid in, but Herstatt Bank had not yet paid out dollars. And when the German authorities closed Herstatt Bank, the counterparties that had paid in their currency, I think predominantly Deutsche Mark, they were waiting and eventually not getting the US dollars that they were supposed to get back. So that was the trigger for the establishment of the Basel Committee, because there was a need for more coordination at the international level. Then Basel II, because we talked about Pillar 1, 2, and 3, Basel II is the accord that introduced the 3 pillars, and it became a more sophisticated risk management and measurement approach. So Basel I was more coarse, if you will. And then in the financial crisis, the realization was, even though you were in compliance with capital ratios, you had liquidity risk that was still prevalent on the bank balance sheets. And then a lot of liquidity regulation came as a result of Basel III. And that's where we are now, but there's still ongoing development. And also, interestingly, maybe a bit of a history deep dive now, the savings and loan crisis, I think we briefly touched on that in the historic overview. The savings and loan crisis led more to regulatory changes in terms of minimum capital requirements, in terms of deposit insurance, where the premiums went up, in terms of restrictions on non-residential mortgages, but it didn't really lead to lots of regulation around interest rate risk in the banking book, even though the savings and loan crisis was essentially an asset liability management crisis in the same way as Silicon Valley Bank was. And yeah, I think I'll pause there if you have any questions on this. Otherwise, we can.
So maybe it happens when you go out with your wife and you're having dinner and somebody asks you what you do, but you certainly get these voices all the time who'll just say, they'll say, why do we have these crises and these regulations? We should just do, one-to-one banking. So we shouldn't have fractional reserve banking. Or people say, we should stop with this stupid paper money and we should go back to a gold standard. Or third option, they say, all of this is garbage and we should use crypto. And, we're diving deep here, but, what's your dinner party sort of short, easy sort of response to that?
I think you would not be able to sustain the required growth that the economy needs if you went back to gold standard, for instance. And I think that's also one of the key reasons that we got away from that. And it's the same. It's the same if you think about a one-to-one banking system where you do not have leverage, or banks don't provide the amount of credit they do today. That would have severe implications for the provision of credit at a macro scale to the economy, and it would slow down economic growth. The tricky question then is, how do you constrain that lending such that it's positive for the economy, but it doesn't overextend itself such that you get into these cycles of a boom and a bust.
And so just to, I mean, I kind of made that point, and but I just want to kind of unpack it just a little bit, and just so what you've just said is that a different kind of banking system that doesn't include, for example, fractional reserve and goes to something like a gold standard or something else might be workable, but we would have very, very low growth or zero growth in the economy. And I'm putting you on the spot. So I'm the the wife of a friend, or the non the parenting side of the couple, and I say, well, why? Why would it lead to lower growth?
So if you essentially there's not enough gold to back up all the claims that we currently have in the monetary system. So if you want to start a company, let's say a restaurant, and you think there's too few restaurants, or the restaurants that are around, they're not good enough, I want to start a new and a better restaurant. If you don't sit on a pile of cash, you need money to pay rent or buy a shop. You need inventory, you need to buy food, you need to pay salaries. And if you don't sit on the cash, then you need funding. You need a credit to get started.
Yeah.
And it's the same. It's not just restaurants, but any economic activity. If you don't have the funds to fund it, you need credit to go and do it. And if essentially if you restrict the amount of credit, then you restrict the amount of such enterprises and companies being started, because in the extreme case, you would only allow self-funding people to do this. And that's essentially how the central bank then tries to steer the economy with the interest rate. So if you make funding very cheap, if you have low interest rates, the return that you need to earn on your company or investment is relatively low compared to the cost that you pay for the credit that you took out. If rates are higher, there's a much higher return that you need to earn. So it raises both the entry bar in terms of profitability, but it also squeezes the ones that are already in. And that's how, if you then try to extrapolate from the micro perspective of a single company to the macro perspective of the economy, that's how you get an economy that's at the point of overheating, going into an inflationary mode, back down, because you make it expensive. I think Volcker once said, in response to how do you fight inflation, you essentially cause a recession, which was somewhat of a blunt answer, but that's it. You raise the funding costs, and inevitably, unfortunately, some businesses will go out of business. And then on the downswing, if you see there's too little economic activity, the economy is doing poorly, you make funding cheaper, you lower the entry bar for new companies to come in and stimulate economic activity.
Yeah, it's very well put. I have a comment and then a question. So my wife is from Monterrey, Mexico, and at least one person will have grown up in or lived or spent time in a place like that. And in places, when I think of dating my wife and visiting her or traveling with her to Monterrey, it's a place where the rich get richer, in part. Why? Because the people, the middle class even, let alone the underclass, don't have access to bank credit. They can't even start a shop because credit is not widely available in the economy, and they can't buy a car on credit. And so, the business of starting shops or and being entrepreneurial is the opportunities sit with the wealthy families already sitting on businesses or real estate that generate large amounts of cash, and they have an easy time putting their cash to work in opportunities, whereas the people and those people who might have started a business which requires a little bit of capital, have to go and work as employees because they can't get the credit from the bank. So this idea, it's kind of interesting. So that's the statement. And then the question is, I imagine myself into a role of central banker, and one of the things in it, what you've said reminds me of it, is that what we really ideally want for the best possible functioning economy is to provide vast amounts of credit for investment that increases the productive capacity of the economy. But we don't really want to provide credit for, spurious purchases that don't go into production. They're just consumption. You don't actually want to finance consumption. You want to finance investment. So the buying capital goods is easy, but allowing people to borrow to buy Christmas presents is the other side of it. And as far as you're aware, are there any sort of instruments or tools that can kind of direct the credit more to the productive investment activities than the other?
Some degree, borrow-based measures can try to address that problem. People need to have housing. So if you buy a house, that's going to lead to some productive growth in the economy because somebody needs to build a house.
Yeah.
And you get cheaper funding in your bank if it's your first home that you
Yes.
buy. You also get cheaper funding for that compared to consumption credit.
So
Sorry?
simply a VAT sales tax does that. So the consumer at the end pays a sales tax, but everybody who's intermediate gets to deduct that. So that's but in any case, yeah, thank you. So let's go back because I always drag you off topic and down
But
rabbit holes.
this is a lot of fun.
Yes.
So
So
now
back to banks.
back to banks. Now, net interest income and economic value of equity. We've talked about it already for 2 episodes. Now we're actually going to calculate this in two very simple toy examples. So we'll take a fixed rate loan with $1,000 notional and a fixed rate of 3.5%. I'll assume it's a 2-year loan and the interest is paid every 6 months. So we'll start with NII and the fixed rate loan here. So every 6 months, as I said, we pay 3.5%. The baseline 2% here is simply the risk-free rate. So I'm assuming a flat yield curve at 2%. And every 6 months, I pay $17.50. And the total cash flow, I'm ignoring the principal repayment at the moment. The total cash flow on interest is $70.
So
Now,
forgive me, I need to understand how you calculate that. So you've got $1,000, 3.5% is $35, and that's broken down. The 17.5 represents
because
the
it's
risk-free rate.
exactly 3.5 is the annual rate, and then because you pay it semi-annually, it's half of the.
Right. Okay, got it. Thank you.
If
Okay.
rates now move by 100 basis points, so 1%, that's essentially a simplified version of the BCBS scenarios that we talked about. We're not going 150 bips, but just 100 bips. Then we're still paying $17.50 because it's a fixed rate loan. So no matter what the interest rates do, we pay 17.5 to a total cash flow on the interest rate, ignoring the principal, of $70. And then the third column is, again, exactly the same thing. For 100 basis points down, we still pay the same thing. And then delta NII is, as we mentioned, the difference between the baseline and the shocked scenario. Because we pay exactly the same thing in the shocked scenario, if rates go up or if rates go down, compared to the baseline, delta NII is exactly 0. And this is not really NII, this is the interest income. So we would also need to deduct the interest expense to get to the net. But if we assume that this is funded by equity, so essentially interest rate free funding, we can say for simplification, this is the net interest income.
And just to understand, you've gone out 24 months just because there's
just for the sake of argument.
But it might be a 10-year or a 20-year.
Could be 10 year, could be 1 year. Yeah.
You're just modeling it out 2 years.
Yeah.
Yeah.
Now we look at net interest income again, but for a floating rate loan. And here we assume that it's a floating rate loan based off of SOFR, which is a dollar rate, and we add a margin of 50 basis points, so 0.5%. That means at the prevailing SOFR rate of 2%, you pay 2.5%. And the notional is still the same, $1,000. And what happens, it will, of course, reprice, but we just assume that over the 2-year horizon, rates are not going to move. They're going to stay at the 2.5%. So we pay 2.5% annually, half of that. So 12.5 at each of these 6 months intervals for a total of $50. Now, because this is floating, if today rates increase by 100 basis points, then we're not going to pay 2% plus 50 basis points, so 2.5. We're actually going to pay 3.5. And paying 3.5, we're exactly back to the cash flows we originally were paying under the fixed rate loan, so 17.5, and we get to the 70 in the end. Symmetrically, if rates go down 100 basis points, we're not paying 2.5, but we're paying 1.5%, and that's 7.5 at each 6-month interval for a total of 30. And now delta NII, you can see, actually changes. So if rates go up, we have plus 20 relative to the baseline because we pay 70 versus 50. And delta NII is negative if rates go down. We only pay, so the bank receives 30. It's a loss from the bank's perspective, but it's, of course, a gain from the credit taker who only pays 30 instead of 50.
So just to be helpful, Eric, I think that you might have shifted perspective a couple of times from the borrower and the lender. And
Yes.
so obviously there's two different sides to this. There's one guy who's paying it and there's another guy who's receiving it. And so whether you call it green or red, I mean, you can look at it from both perspectives. But imagine that you're looking at it from the person who's loaned the money out, I guess, and on a floating rate in the second example, they're receiving cash flows. If it's floating rate lended out and the interest rates go up, obviously you're in the green, you've received 20 more over those 24 months. And if the interest rates go down, it's floating rate, you've received 20 less over those 2 years.
Exactly.
So
yes, so we essentially take these numbers take the perspective of the bank. It's a positive number and it's an income, and a negative number would be an expense from the bank's perspective. And it's positive here because the bank is earning 70 instead of 50. Let's go to the economic value of these two same loans. Now, what we do is we take the same cash flows, but these are nominal cash flows, and now we convert them into a net present value. There's different ways you can do this. You can do continuous discounting. You can do what we do here is simple discounting. So we calculate the discount factors, which means you look at $17.5 today is worth $17.5, but $17.5 in 10 years is obviously worth less than if you got them today. So what are 17.5 in 6 months, 12, 18, 24, or further out? What are these future cash flows worth today? That's the net present value. This is how you calculate a simple discount factor. So we have 2%, and then this is the 1-year discount factor. So you've 2%, you've got essentially 1 year, 365 or 365 days, and then it's a bit artificial because this is all simplifies to 365 or 365 again as the exponent, and it gets you to 0.9804. So the net present value of the 1-year cash flow is then 17.5 times the discount factor, which gets you to 17.16, and that's the 17.16 in the table here.
And I would imagine you used the 2% rate because we're imagining that this is mortgage-backed securities or government paper, and so that's an appropriate discount rate.
Exactly, we're using the risk-free discount rate
because it's a quasi risk-free asset.
No, we're oversimplifying a little bit.
Yeah.
So
okay. Just
we would essentially have to back out the risk-free component of these cash flows and then discount them. But for simplicity, we simply take the full cash flow. And here, importantly, we also need to consider the principal. previously for NII, we don't really need to consider the principal because the principal it's the same nominal value. But when we consider the net present value of the principal, even though it's 1,000, it will change in net present value terms.
So you would have had an assumption about the maturity of the bond, and because you have to, the maturity determines what the current value is. You have to take into account the ultimate balloon payment at the end plus all the interest payments. So say if it's five
Yes.
year, got another 3 years or so to go.
So this is assumed to be 2 years. So
Oh, it's a 2 year
the
bond. So
exactly.
okay, fine,
At the end of the 2 years, you get back
got it.
the
Okay,
principal. There's interest payment only for 2 years, and then bullet payment on the principal.
yeah. And we get to a delta EVE at the bottom,
Exactly.
which is very, very close to the delta NII in this case. It's almost the same thing. And if oh no, hang on a
No,
second.
no, it's not. So the delta NII is 0 because you get the same
Yes,
cash flows.
yes. Sorry,
But the delta EVE
is
is large
yes,
because
yes.
if you if
Sorry.
you if you get the same cash flows, even though rates have moved up, economically you've made a loss.
Yeah,
You should, all else equal, be getting a higher cash flow for the credit risk that you're exposed to. But because you're not getting a higher cash flow, because the rate is fixed, you've essentially made a loss. And the loss is about $20 in net present value.
I was comparing to the floating rate loan, which of course is not appropriate. It's a different scenario. So one is a flow, one is a stock, one is a balance sheet item, one is an income statement item. When you're looking at net interest delta and NII, you're looking at an income statement flow through time,
Mhm.
whereas when
Yep.
you're looking at delta EVE, you're looking at something that would go onto the balance sheet. And so it seems to me that one is related to liquidity and the other is related to solvency in a way.
In a way, yes. Or more to earnings and income.
Yes.
NII would be, yes,
So NII relates to the impact to the income statement, whereas EVE relates to impacts to the
capital statement.
to yeah, if you were to true it up and mark everything to market.
Exactly.
Yeah.
It's a hypothetical marking to market.
It's worth saying that there are plenty of instruments and ways of that one can manage a bank or a financial institution's balance sheet to convert income statement income. You can move stuff back and forth between the
Mm.
income statement and the balance sheet. And there are instruments that maybe they have other impacts as well, but if you decide that you're showing too much income, you can shift it to the balance sheet and vice versa. So anyway, I don't know why I brought that up. I need to let you continue. Make progress, Eric.
And and this is essentially what happened. This is again Silicon Valley Bank in a nutshell. Silicon Valley Bank was earning the same fixed rate coupons on its treasury portfolio. So there was no change in NII. It was the same cash
Yeah.
flows, but the value of these cash flows was much lower because rates had increased a lot. And hence, there was an unrealized loss, and unrealized in the sense that it's there in economic terms if you mark the whole thing to market, but you don't have to yet.
Yeah.
And symmetrically again, then if rates go down, but you get the same cash flows, that's actually worth more. So there is an economic gain of 19.97. And then the last example is delta EVE for the floating rate loan. Here, there's nice symmetries. If rates move up and you have a floating rate loan, when the loan reprices, then the interest rate payment goes up as well. So discount factors go up, cash flow is worth less, but at the same time, the cash flow itself also increases.
Yeah.
So instead of getting the 12.5, we get 17.5,
Yeah.
and the 17.5 is worth more. So 17.24 if we net present value that. And if rates move up, we can see that the economic value of equity barely moves because
Yeah.
you also get more in terms of the cash flows.
Yeah.
And symmetrically, if rates go down, you get fewer cash flows, but it doesn't matter because each unit of that cash flow is worth more. So again, in economic terms, your net present value doesn't change, and the delta EVE is essentially 0. And that's that's also one of the reasons why you have this dual view of NII and EVE, because you try to capture both the income perspective and the value perspective.
This is all super sensitive to picking the right rate of interest.
Yes.
And yeah, so, or not the right, but you know, the rate at which you discount it is super, super important. And
Yes.
I can imagine debates happening in a government bond, a US government bond. It would make sense to me that you can discount those things at the risk-free rate. And
Yes.
and I don't know exactly. I mean, I'm sure what happens when you move out to a corporate bond where there's a risk-free rate component. You might say, well, there's this component we can discount at the risk-free rate. And it's only when you divided out all the different components of the interest rate, we only have to discount the component of the interest rate that represents company-specific and industry-specific risk. And that probably makes a big difference to what these
Yes.
numbers turn out to be.
And the regulation asks you, this is why this is a bit of an oversimplification, because the 50 bip margin, that would include some credit components.
Yeah.
So we're essentially discounting risky cash flows with a risk-free rate here. And that's what regulation precisely asks you not to do. Either you're consistent that you use risk-free cash flows and you discount them with a risk-free rate, or you use the full cash flow inclusive of margin and credit risky items, but then you also need to discount it with a risky interest rate.
And every time I kind of go because I think, no, shut up, guy, and then I think, no, I want to ask the question. So I think that one of the things I just take away from this briefly is that I think that rather be approximately right than precisely wrong. What one can do here is, for example, note that if you have, I mean, effectively, a very simple conclusion from what we've done so far is that if you're, in this case, lending out at a floating rate, there is far less risk to your balance sheet, for example, because you can
Yes.
see that it evens out. And so
Yes.
it's not so much whether it's plus 0.12 and minus 0.02 on the very, very bottom. It's the fact that it's close to zero. And a question that I have when I used to do many more discounted cash flow models than I would right now, I think that as much interest for me was to see how the numbers moved when I plugged in different interest rates, because you'll
Mhm.
get something, especially if you go out 20 years, where on the floating rate loan on the very, very bottom, and you're calculating economic value of the equity, what happens to the value of those cash flows going out 20 years? And you look at concavity and convexity or the exact shape of the yield curve, and you may have some very, very interesting movements that take place. It's not obvious that they'll cancel each other out, basically. So when you're modeling this inside your bank, do you play with, I mean, I guess a lot of it is in a spreadsheet. Do you play with the spreadsheet and plug in numbers just to see how they move?
So we try to have as little as possible in spreadsheets, but the thinking is essentially the same. For EVE, the further out you go, the more sensitive the whole thing becomes to your discount rate.
Yeah.
And that's why essentially banks, you would rarely have fixed interest rates on mortgages beyond 10 years, for instance, in Switzerland or Germany. They would reset after that period. And things like, for instance, long-term funding of you can have some Pfandbriefe or debt issuances. They can go beyond 10 years. Those would be hedged with an interest rate swap, essentially back to back, such that the full interest rate risk is hedged, because it's just so sensitive that far out in the future. So
So okay,
banks generally
let's
don't take interest rate risk.
so we're going to go there for just a short second. I'm right now just the only person I feel like in the room with Eric, but there'll be somebody else who asks these questions. So bank issues a 10-year bond, fixed rate,
Hmm.
and they want to hedge the interest rate risk beyond 10 years. And then, Eric says, and he says, you do an interest rate swap. And actually, for everybody's benefit, Eric has explained to me before over a wooden table in our conference room an interest rate swap. But It feels
We're
to me as
getting
that
there. We're getting there in 3 or 4 slides, I think.
3 or 4 slides. Okay, so should I just, so everybody, it felt to me like Eric says, oh, and that's easy, just go get an interest rate swap. And I'm like, you just said that you can't, the market's become illiquid and all sorts of things 10 years out, and there he is getting an interest rate swap for years 10 to 50. But so should we just park that and we'll come back in 3 or 4 slides? Is that what
I
we're going to
I
do?
would suggest.
Yeah. Okay, good. So stay tuned and you'll find out about interest rate swaps.
Exactly. And just before we go to interest rate swaps, we touched on this briefly last time, but I think it's relevant nonetheless, maybe to briefly repeat. The treasury function is the bank within the bank, and it's pooling all of the mortgages that have been issued by the bank, and it's also pooling all of the deposits received by the bank. So if we go back to, I think this was in the first, maybe, there we go, session, you've got a reference rate, and then you have a margin on top when you lend, and you subtract a margin when you borrow. This margin revenue, that's what goes to the business areas or the relationship manager who face the customers. And the maturity transformation, the term premium, that will go to the treasury function or the banking book. And it's the treasury function that essentially manages the interest rate risk from the combined lending and the combined deposit taking of the bank. So it's not a one-to-one thing where every relationship manager looks at how many loans has she or he given out and how many deposits do her or his clients bring in. It doesn't really matter. Everything gets pooled to treasury, and all of the deposits will get remunerated at a funds transfer pricing rate, FTP rate. So that's an internal yield curve. And the loans will get charged at that rate. So this is what this figure essentially shows. You have borrowers that take out a mortgage, and you've got the lending business line, so the relationship manager that provides this loan to the customer. But that business line is getting the loan itself internally from the treasury function or from the banking book team. And similarly, the funding for this will come from deposits, and these deposits are all transferred again internally from the retail client or business banking divisions to the treasury function, which then manages this in a portfolio manner. And you can see this split in a bit more detail here. So the FTP, fund transfer pricing rate, that's the same for borrowing and lending internally in general. And then you have markdowns on deposits, which gives you a customer rate in this example in 1%. And you have markups, which is expected losses, capital charge costs like rent and salary, essentially. And then an actual margin, which is the profit that the bank will earn, which then gets you to the customer rate. Now, this is an excessive example. You would not generally have 1.5% on top, but this is just for the sake of illustration. Sorry.
Yeah. It depends on the client as well, if you have a big client, small client. But I have because I know rabbit holes. And so I've talked over my lifetime to various different kinds of people who have a business. An example would be a merger arbitrage, various different kinds of trading, of exploiting price differences between different instruments. It might be in commodities markets or elsewhere. And in order to make money in these business models, you need to have the availability of large amounts of capital to commit to these mispricings, often on two sides of a transaction. And these groups have extremely smart, capable people in there, and often they have to react fast to market developments because the mispricing doesn't last for long. The only way they can work is to attach themselves to a bank with a treasury function, which has this kind of treasury function taking place, where they're obviously lending out to corporate clients. They're taking deposits from various different retail and corporate clients. But then there are these specialized capital market functions. How do they interface into the treasury? Because the treasury of the bank can allocate capital to, bank lending, but they can also allocate capital to these kinds of specialized traders.
That's generally not considered from a treasury perspective. That would be credit risk. Credit risk will look at what's the credit exposure that you have in retail clients, and then disaggregate this in Swiss versus Austrian versus Scandinavian retail clients versus corporate clients, and then what sectors are you exposed to. From the treasury perspective, giving out a loan to business banking or to private banking is the same thing. You can, depending on, now we get into balance sheet steering, you could have different FTP rates for business banking versus retail customers, for instance. Let's just stick with retail clients. If you want to incentivize the bank to take in more deposits, you would increase the internal reference rate, because then if the FTP rate is higher, the other costs and the markdown, they will stay the same, but then you go from 1% up to 1.2 or 1.3%. So the rate that you pay as a bank on deposits is more attractive relative to the competition, and you will attract deposits. Conversely, if you're sitting on lots of deposits, but you want to incentivize more lending, you can reduce the FTP rate with a management overlay, and that will make your lending comparatively cheaper to the competition, and thus your bank starts to issue more loans. And you could do that if you wanted to incentivize lending between private banking, retail customers, and business banking. But in general, Treasury will just see this is a loan at a certain maturity, and any sectoral concentrations and credit risk considerations, they would fall under the mandate of the credit risk function.
So the guy who runs the merger arbitrage desk, how does he interact with Treasury?
He gets funding from Treasury. That guy would generally sit in the investment bank, and the investment bank would then, this depends then also on the FTP setup. If you do this in a fair way, you would say, well, this is an illiquid transaction. You need funding for 5 years, so you're going to pay a 5-year rate. That's the cost that Treasury is going to charge the investment bank for this 5-year funding. If somehow you, however, say, well, yes, this is an illiquid transaction, but actually we could get out of it, so it's not really a 5-year transaction, it's a shorter transaction, then it could be that Treasury charges you a smaller or a shorter rate, which is then lower.
Are you involved from the risk? That's Treasury, actually. Are you involved in analyzing the risk to some of these more specialized business lines?
From an interest rate perspective, yes, we cover the funds transfer pricing framework.
So, okay, making progress.
Yes. So now we get into risk measurement and management. We've already talked about this yield curve, simplified yield curve, quite a bit. So now what we want to do is essentially draw a gap profile, and start with the balance sheet. We've got a very simplified balance sheet, and we went through this in great detail. So just quickly summarizing again, on the asset side, the main things we're interested in interest rate risk in the banking book are our loans, and the cash. And loans disaggregate into fixed rate loans and floating rate loans, which we've walked through in the NII and EVE examples. And on the liability side, there's actually a few more terms that are important. We have the sight deposits, which are non-replicated or replicated. There's a typo here, it's twice non-replicated, so one of them should be replicated. And replicated simply means while they have a contractual duration of overnight, you can withdraw the cash at any point in time, the model duration is different from that and is longer than term deposits, which is a deposit with a fixed maturity and a fixed interest rate, and then long-term debt and short-term debt issuances. So this is capital market or money market activity of the bank. Now, in this example, the bank has issued a fixed rate loan at 2.5%, and it's funding it via deposits. So nominally or notionally, this is of the same size, but the interest rate risk isn't really apparent yet. And that's why you use a gap profile. So here we're assuming there is a 3-month duration to this customer deposit. So it could either be a 3-month term deposit, then it would be the upper category here, or we could say we've just modeled this to be a 3-month duration deposit. It's maybe even easier if we say it's contractually 3 months, because then everything is contractual for the sake of argument. So we have a contractually agreed 10-year customer loan at 2.5%, and we've got a contractually agreed fixed term deposit at 3 months, paying 0.5% to the customer. And now the question is, have we made a killing because we're now earning 2% over the next 10 years? Well, the answer is no, because there is a huge gap risk, which you can see by virtue of having an asset overhang in the longer tenors. So there's more assets than liabilities here in 10 years. And we have a liability overhang in the short term in the 3-month bucket.
Oh.
So,
So you're just
yep,
modeling there the expected cash flows in and out over time. Is that
yes,
right?
exactly.
So just to be clear, because one could imagine that those are, you're talking about basis points on the vertical axis. You're just talking about, 50 units of dollars or whatever. So
This
there
is,
you've got,
yes, this is 175, I think, roughly $175 or
yeah,
$1,000 or $1 million, depending what we're funding
yeah.
on the asset side, and the same is $175 on the liability side.
For what it's worth, we inside of Aqua Marine Fund, even though we basically have, equities on the one hand on the asset side, and our liabilities are effectively shareholders, we model out, we look at expected, we can realize our portfolio. It's a floating portfolio of equity floating portfolio, but we modeled out expected redemptions
Yeah.
and we have a cash flow waterfall. That's a cash flow waterfall basically.
Yes.
And
You have liquidity risk. You also you have an asset liability management problem. You need to
yeah,
estimate what redemptions. I presume you've got lockup periods, but then you have a waterfall of when
yeah,
these come due, and you have assumptions. We get into option risk. You make behavioral assumptions on your clients whether or not they're going to withdraw.
yeah.
And does this depend on the level of interest rates? Does this depend on what the stock market does? What are the factors that will influence whether or not the customers will withdraw, and how much cash on hand do you then need to hold
Yeah.
to meet these redemptions, such that you do not get squeezed by needing to sell, especially into a falling market?
And one of the key aspects of this little balance sheet that I run, and effectively I run a $400 million balance sheet approximately, is that the promise to the client is to give them the value of their proportionate share at the time when on the value date. And so
Yeah,
there's no contrast with fixed income bank asset and liability management, where the promise is a fixed amount, a fixed
yeah,
cash amount. I'm just promising them the value of the valuation at the date at the value date. So I have my what I'm obligated to pay them is completely floating and completely proportionate to the value of the assets. Contrast that with the person receiving the redemption has total uncertainty about what they'll get on the final date, because it depends on the commitment is it's the value on the final date that they get nothing else.
yes,
I'm not exposed to, say, pricing risk. And
no,
you contrast that with this, where the commitment is you get a specific sum of money,
yes.
a notional amount. And
But you're exposed to liquidity and liquidation risk, because, say, if many clients redeemed at the same time, then the market value of the portfolio would probably be different from the realized
yes,
value.
you're absolutely right. One of the other things that we model here is days to liquidate. And again, it's assumptions, because you have in the portfolio, you have very, very large positions companies with
Mm.
our proportion, we would easily sell into the daily volume. And there may be
Yep.
positions where we would not easily sell into the daily volume. And it's worth saying there are small cap managers, especially, get into that problem where suddenly they have to liquidate more. And they're, our agreement with the investors that we have mechanisms to prevent that in all sorts of ways. But yeah, it's so that is a liquidity risk. And it's
Yeah,
interesting because in terms of what we were saying earlier on, which is cut off in the beginning, because more than 80% of the investments of the fund are large cap, the probability that there is liquidity risk is unbelievably small.
yeah.
But to your point, what if there is? What if the markets are shut for 3 months? It doesn't hurt to go through that thinking. And it's
And
an
what if the market is irrational for 3 months, and fundamental value, whatever that means, is there is a wide gap between the fundamental value and the current price, but you have to realize the current price because you're facing a redemption. Then
funnily enough, the funds like mine have been around for a while. The lawyers pretty much will be very unhappy with you if you don't write a couple of clauses into your agreement for your investors. One is that every fund that I've seen is allowed in extreme circumstances to suspend redemptions.
yeah,
Which is one thing. So you're allowed to say you can't get your money just yet. That's never happened. And even though it's written into our fund documents, it would be a source of great shame if that were to ever happen. And all the way through the financial crisis, all the way through, people want to put their hands on their money, they can. The other way in which they write protections into the fund manager is that they say at any time, extreme or non-extreme, redemption requests can be met in kind, which would mean that the fund manager can select securities to send
yeah.
out. But that's never ever happened. And I would rather deliver lower returns, but always be in a position to be able to meet liquidity. But it's interesting because it's one of the things that I came to this conversation with was a presumption that we're going to analyze banks and none of this applies to Aquamarine Fund, but actually some of it does apply to Aquamarine Fund. And I would actually say, Eric, that we look at possible redemptions and redemptions that have happened, but what we don't do, which actually I've noted down, we can model expected redemptions. So
Yes.
on any book of investors, once you get to large numbers, there'll be people who redeem because of a life change. People move
Yes.
houses every 5 years in the United States. People die every now and then, and those create life changes that force a rejig of your financial setup that can result in redemption for us. And even though no redemptions have been notified, we can model those in actually. And that's the modeling that happens on these sight deposits. I think
And
what I
this,
find hard, and it reflects something that happened at Silicon Bank, if we just go back to the balance sheet that we're looking at, is that so the duration of deposits, they're sight deposits, which means you can put your hands on them anytime.
yes.
And you could have sight deposits in a benign environment that are continuously growing, and actually the effective duration is kind of infinite. And
Yeah.
then something happens and the duration changes very, very
Yes.
rapidly. And so how do you model that? Because you don't actually want to model the steady state. You want to model the extreme circumstances. And in a bank's case, whereas it's written into my fund documents, we're an equity investment, we're allowed in extreme circumstances to suspend redemptions. A bank can't
We can't
suspend
suspend. You can't suspend
people putting their
redemptions.
hands on their cash that they put in a bank site deposit.
No.
So, so what, how do you model site deposits? I mean, what is the duration of site deposit? It depends, doesn't it?
It depends. That's probably the next podcast. There's models, both historical and then expert judgment. These two components get combined, and then you try to predict how these deposits behave. And there's two aspects to it. One is from an interest rate perspective, where generally you look at interest rate risk or interest rates as a driver of behavior. So if rates go up, you will have a flux from sight deposits to term deposits, because at zero interest rate, you also get roughly zero on your term deposit. So why would you lock up your cash for a certain amount of time for essentially no marginal gain relative to having it on the current account? But if interest rates are high, you get a much lower return on your current account compared to savings account or an account where it's more difficult to withdraw money. And the most difficult one is simply a term deposit, where you say this is my money for the next 6 months, and you can't get it out until the 6 months have lapsed. You get a much higher interest rate for that, of course. So if rates go up, then this liquidity preference decreases because there is a cost to it, and customers then prefer to lock up the cash for 3, 6, 9 months, but they're in a higher interest rate. And conversely, when rates then come down, you see again a flux out from term deposits and into sight deposits, because the added value of being in a term deposit decreases.
So you're going to share the cash flow waterfall for the current bank that you work at? I guess not. Just kidding. But I don't think I've seen those. I mean, that would be something that it would be nice to see in the bank reports in their publicly stated accounts. But here, go into it. So now there's the gap profile.
Yeah, it's not public, but the European Banking Authority has requested that this be reported to the regulator. So the regulator sees it, and internally it's of course been it's reported on daily frequency, because that's really that's the bread and butter and the core of the risk that that you need to manage, both around liquidity and around interest rates. And I was just going to say, there's probably interesting mathematical problems, both in terms of a law of large number. If you have many customers in Aquamarine Fund, you can say something about the average behavior of the customers, but you can also, I think with machine learning, you can drill down to more granular levels. And you talked about live events in banks, for instance. If you for instance see that a salary payment stops coming in, it's likely that the person either quit their job or got made redundant, or something else happened. And if at the same time you also see that there's not much savings on the accounts, then the likelihood, of course, increases for this specific customer that they will default on their mortgage. So combining different data sources, you can then also, even though nothing happened in the macroeconomy, and you wouldn't say the general credit risk for your lending portfolio has increased, you can make inferences on individual customers based on individual customer behavior.
Yeah. So I have a friend here in Zurich who has done modeling work on exactly that, sort of looking for indicators of the potential of somebody to leave the bank, to reduce their deposits, to change their payment behavior. And it's based on, all sorts of signals that are not properly measured and that's kind of fascinating, actually. So it might be a late payment would be an obvious one. And it might be late for by a few days. What are some of the other ones that might indicate?
This would be credit risk. So this is outside of essentially my area of expertise. But certainly differences in payment timing, probably also differences in spending behavior. If you see that somebody is spending 30% of their salary on a monthly basis, but now the spending has gone down and the savings rate has gone up, that's probably also a signal. Maybe it's a signal that they're saving up for a holiday or for something else, but it could also be an indicator of expected stress for the customer.
This is kind of like very, very tangentially related, but anybody listening to this, and maybe you already know this, but if you are in a situation of financial stress, then, and you cannot pay all your bills, then two things: pay part. Even you owe $100, pay $1. In the other side of that transaction, in the financial institution, a partial payment still keeps the payment current. And for example, that would prevent you potentially from moving into a class of customers who are now credit stressed or in workout of some kind or other. I would also say that when you're stressed about paying bills, so large institutions can manage customers who go into stress far better than individual contractors. So you favor individual contractors, people who have small businesses. And the last thing is get on the phone. Talk to them. Tell them what's going on. Don't hide. So, hello, I've got the bill. I cannot pay it right now. I'm sending you X%. I'll keep you posted. That makes an enormous difference to one's business reputation. And I think, and it's funny because I don't know where but those are really important things, really, really important. But so we have this chart up, we haven't talked about it. So let's talk about Oh, shoot. Yes, we're going to
Yes,
finish this and then you need to go in
exactly.
about
I,
3 minutes.
unfortunately have a hard stop, but I was just going to talk about this one.
Yes.
We had the impression that we were going to make money fast and it was easy money because we were funding this 2.5% loan at 0.5%. But now interest rates have skyrocketed, and suddenly the 3 month rate, when this deposit comes due, and we've paid the customer 0.5% before, but because interest rates now have gone up, and we've seen exactly this happen over the last 3 to 4 years, not even 4 years, 2 to 3 years, now the customer is going to expect, because the 3 month rate is at 3.5%, the customer is going to expect at least 3%. So we would, of course, expect also a much higher interest rate on the loan, but because we fixed the loan rate at 2.5 for the next 10 years, it actually means that for the next 9 years and 9 months, we're still going to earn the 2.5%, but we now have to go and refund this or refinance this at 3%. So now instead of earning 2% over the next 10 years, or 9 years and 9 months, we're actually going to pay, if nothing changes, we're now going to lose 0.5%
Yeah.
over the next 9 years and 9 months. So this becomes a huge loss-making trade, and how to avoid that, it's almost like a Netflix cliffhanger. That would be in the next session then.
Yeah. My very brief thought is, what's fascinating to me is how many banks got into this. And
Yes.
so many people at the bank understood it, but a decade or two of declining interest rates down to zero or close to zero sort of just made them forget about it, basically,
Yeah,
which
you
is
think it'd
just
be because rates were low, they're going to stay low forever.
yeah. Eric, thank you so much. Looking forward to the next installment,
Thank you so much.
and wishing you a good meeting at the top of the hour.
Thank you.